Hello, I'm Sahil Sanvi from Monarch Networth Capital, and today we'll discuss an investment opportunity in a value stock, which is Tata Metaliks. Tata Metaliks is a premier ductile iron pipe manufacturer and a foundry-grade pig iron producer located in Kharagpur, West Bengal. Now, it has an integrated facility in Kharagpur which has 500 kiloton of nameplate hot metal capacity, out of which 200 kiloton is converted into DI pipes and the rest is sold as pig iron. The company also has strong financial and technical backing from its promoter Tata Steel, which has about 55% stake. The company has announced an expansion in which it will double its DI pipe capacity, debottleneck its hot metal capacity to 630 kiloton and also install a coke oven and a waste heat recovery plant. Now this will imply that the proportion of revenues from DI pipe will increase from 52% currently to 73% in FY23. Now as we can see in the chart that the DI pipe business has always made higher EBITDA per ton because it is a value-added product and also has higher realization. That is why we believe that the blended EBITDA per ton of the company will rise by 30% in FY23 just because of the change of product mix. Now let's look at the demand side scenario. DI pipe is basically used for distribution of water. According to verified sources, only 25% of the households in India has access to functional tap water with less than 10% penetration in some of the densely populated states in central, north and east India. The government's Jal Jeevan Mission, which wants to ensure that every household in India has access to functional tap water with a budget outlay of 3.6 trillion rupees, will bring in robust demand for DI pipes in the next 3 years. With 70% of Tata Metaliks DI pipe sales coming from these under-penetrated states in north, center and east, we think that the company is well set to gain market share by at least 5% in the next 3 years. The first one is pulverized coal injection and oxygen plant, which is expected to bring in a cost savings of about rupees 400 to 800 million and increase the hot metal output to 600 kiloton. Now this is already showing results with a 10% reduction in coke rate and a 20 kiloton improvement in the hot metal output in FY20. The second is the installation of a coke oven, which will increase the captive coke production from 47% in FY20 to 73% in FY23 with cost savings of rupees 250 to 300 million. And the third is the setup of the waste heat recovery plant, which will bring in annual cost savings of rupees 700 million and also make the company self-sufficient for its power requirements in FY22. Now we also did some ground reality check to understand how is the demand for DI pipe, and we were happy to know that most of the DI pipe contractors were receiving new orders even amid the lockdown with no cancellations. However, we did see some slowdown in the execution of these orders because of the shortage of labor, which will only improve once the infection rates goes down. Lastly, on the threat of replacement of DI pipes by either HDP pipes or MS pipes, we believe that threat is very low because the other pipes fail to handle high water pressure. Now let's speak about the financials of the company. On the back of robust DI pipe demand, we expect Tata Metaliks DI pipe sales to grow by a CAGR of 20% in the next 3 years. On the back of the massive cost saving projects that we just described, the EBITDA margin of the company is expected to grow from 14% in FY20 to about 17% in FY23. The company also has an impeccable history of capital allocation because of its timely debt reduction and capacity expansions. So the free cash flow it generated in FY18 and 19 was used to reduce debt and bring down the debt to equity from 2.6x in FY17 to 0.1x in FY19. Now the company also has lowest cash conversion cycle among its peers, and this is because of two reasons. One, it sells its pig iron on cash basis, and second, the long-term raw material sourcing contracts which it has with Tata Steel allows for higher payable days. Let's speak about the valuations now. The long-term mean of Tata Metaliks 1 year forward EV by EBITDA is 5x. We value Tata Metaliks at 5.8x, which is 15% premium, to arrive at a target price of 680 rupees with a 35% upside and a buy recommendation. We believe that the premium ascribed to the multiple is justified because of the shift to higher margin business, the robust outlook for DI pipes going ahead, the massive cost saving projects, the impeccable history of capital allocation, and also the superior corporate governance. The key risks to our investment thesis are insufficient funding by government for the water projects, further delay in the expansion projects, and the pig iron commodity price risk.